going to have Robert Sitton come and do that.
I tell you what, you're in for a real treat. We had the opportunity last night to have dinner with Thomas and Steve Holbrook, his colleague, and the amount of knowledge that you're going to get from this talk is incredible. So, straight from Boston, Massachusetts. Thomas is an investment officer at MFS Investment Management and institutional equity portfolio manager of the firm's global equity portfolios. In this capacity, he participates in the research process and strategy discussions, assesses portfolio risk, customizes portfolios to client objectives and guidelines, and manages daily cash flows. He also communicates the portfolio's investment policy, strategy, and tactics. Thomas joined MFS in 2002 as an institutional portfolio manager with more than 10 years of experience, including 3 years as Director of Emerging Products for Schroders North America, 2 years as a General Manager for Schroders Argentina, and another 3 years as a Vice President, Latin American Fund Manager for Schroders Capital Management International, London. Prior to that, he spent 2 years as a Vice President of Sales and Research for NatWest Securities. Thomas earned a bachelor's degree from Long Island University and an MBA from Columbia University. Without further ado, Mr. Thomas Melendez.
Well, thank you, Robert, and more importantly, thank you all for being here. Hopefully that's safe. So, I was asked to talk to you about what we think is going on a global scale and global standpoint. And the one thing that I'll start by saying is that the global economy has experienced growth like we've never seen before. The global economy is now growing at a faster pace than we've seen in the last 10 years. And we're pretty excited about that at MFS for a number of reasons. The first of which is what's surprising to us is not only the scale of what we're seeing from a growth standpoint, but how widespread this is. For the first time in a very long time, we're seeing growth not only in the developed part of the world, but also in the emerging part of the world. And this synchronized growth that we're seeing and the magnitude of that growth that we're seeing in various parts of the world is one of the reasons why I remain fairly optimistic about equities as we go forward. And so let's take a quick step back and kind of think about what happened in 2017. Because 2017 was obviously a very good year for global equities, but it picked up on some of the momentum that we had seen in 2016. And so we move into 2017, and one of the things that we saw as investors is that many of the indicators, many of the macroeconomic indicators or the fundamentals actually strengthened as we went further and further into 2017. So not only did we start the year off on fairly good footing, but as the year progressed, that footing got even stronger. Now, that was obviously a very conducive environment for equities, global equities, to grow in general. And we saw that happen. And that environment was helped rather dramatically by the good fundamentals that we were seeing from both a top-down and a bottom-up standpoint. From a top-down standpoint, on a global standpoint, unemployment rates were coming down. When we looked at PMI's purchasing manager indices, they were all going up, saying that the economies of these countries were doing really well. And from a bottom-up standpoint, earnings were coming through at a very good pace. I'm a great believer that stock markets should follow earnings, so as earnings go up, we should see these stock markets following pace, and that's exactly what we did see. And investors were rewarded for investing in equities rather handsomely in 2017, as we saw equity markets go up, as I said, rather nicely with little to no volatility, which was highly unusual. And so we saw some unbelievable returns. Global equities, which include the United States, were up about 24%. But more importantly, we saw some really strong performance from markets outside of the United States. Emerging markets were up about 37%. How many of you are investing in emerging markets over here? 37% up. Developed international markets, so Europe, Australia, some of the Far East, Japan, that was up 25%. Global equities, as I said a little earlier, which includes the US, was up about 24%. And the US was kind of the laggard here, but it still returned a very respectable 22%. Now, one of the other things that we saw in 2017 was that towards the latter part of the year, we got a real good boost in the arm as the United States passed tax reform that was going to provide tax relief for corporations and individuals. The biggest beneficiary of this were the corporations that saw their tax rate coming down from 35% to 21%. But it also compelled these companies to repatriate some of the profits that they had made outside of the United States. And that's one thing that I think we're not talking about, which can be a really big number and a really big issue. So it's estimated that the amount of tax savings that's going to accrue to U.S. corporations because of the tax relief is anywhere from $200 to $250 billion. And we've seen some of that already being distributed in the form of bonus checks to employees. They're talking about, in some cases, maybe even raising some of the wages. But the magnitude of money that U.S. corporations hold outside of the United States is astronomical. Cisco alone last week announced that they're repatriating about $65 billion. One company is bringing back $65 billion. And again, in a plan or a tax saving plan that's estimated to save about $200 to $250 billion. So there's some really good things that are happening here in the U.S. that I think are going to have an impact or going to provide further fiscal opportunities for investors and individuals as we see that going forward. The other thing is that, you know, we're going to see some relief also on the individual side as tax rates come down for individuals, and that means that individuals are going to have larger pools of money. Disposable income is going to be higher, which normally translates to consumer spending, which again helps the economy quite a bit. And so 2017 ended on a really high note. Investors were really excited. We move into 2018, and January starts gangbusters. Non-US equity markets were up high single digits to low double digits. The US market, the S&P 500, was up about 7.5%. And then we hit the beginning of February. And on February 2nd, Friday, February 2nd, the government announced the increase in wages for the month of January. And it was the highest wage increase that we had seen in the last 8 years. And investors panicked. We witnessed the largest sell-off in the S&P in over a year and a half in one day. And so equity markets, as I said, that had been up about 7.5% up to that point, basically went down to even. And the big question is, what had really changed? Because not all that much had changed, yet the rhetoric changed dramatically. Now all of a sudden people were asking themselves, is the bull market over? Are equity markets going to come down? We had experienced a year in 2017 where, just being in the market meant that you were going to make money because there was no volatility. And now all of a sudden we had volatility. The talking heads on the financial news programs, I don't know if you listen to them, I personally don't, but the talking heads on the financial news programs all of a sudden were changing the rhetoric. They were talking about inflation, and they were talking about moves up in interest rates, something that hadn't been spoken about before. I mean, there were questions being asked that would have been considered pure heresy a few weeks earlier. Is the Federal Reserve behind the curve? Are equity valuations in the US too high? No one had been talking about that before. And yet here we are, we found ourselves, having these conversations. I truly believe one of the observations that I've made since the global financial crisis is that investors have changed their mentality. And investors worry more today about capital preservation than they do about making money over the longer periods of time. So their first impetus is to sell and ask questions later. Because they've been so burned, during the financial crisis for maybe not having done anything, so that their first thought is, I need to sell everything, let the dust settle, and figure out what I need to do after that. And I think part of that is the way financial assets, especially financial assets of individuals, have changed. The ownership of those assets. Today, people 55 and over control 75% of household financial assets. I'm going to say that again. People 55 and over control 75% of household financial assets. That number is 15% more than that same demographic controlled 20 years ago. And so, one of the things that we know from history and from data, that as people reach retirement age, their propensity to take on risk comes down rather dramatically. And when they hit retirement age, it basically flatlines. They want no volatility, they want no not understanding what's happening in their portfolios. And so from that standpoint, they kind of change the way they look at environments. Now, I truly believe that this whole reaction to what was happening in equity markets is totally overdone. As I said, earnings are at the highest levels that we've seen in a long time. Global earnings are expected to be up 15 to 17% this year. The economies around the world are firing on all cylinders. Is inflation a conversation we should be having? Absolutely. But is inflation something that I'm concerned with? Not at all. I mean, we're talking about going to normalized inflation. We're not talking about inflation being out of control. We're talking about going to normalized inflation. Normalized inflation in the United States, as far as the way the Fed defines it, is 2%. Actually, 2% inflation is healthy. Some inflation is healthy because what it says is that we're growing. If we didn't have inflation, disinflation is a lot more scary than inflation is. So we're talking about 2% inflation that the Fed is targeting. And let me put this interest rate move into perspective, because I think we've lost some sight on what perspective is. In 2004, the Federal Reserve moved interest rates 8 times. And they call that a measured response. In 2018, the expectation is that the Federal Reserve will move interest rates 3 times. And if inflation gets out of control, maybe 4. So we're going from moving interest rates 4 times in what we believe will be 2018 to moving interest rates 8 times in 2004, and that was considered a measured response. So the problem is that we've been the beneficiaries of an unbelievable bull market with very little volatility, and now all of a sudden investors are getting spooked. But I truly believe this is a good time to take advantage of what's going on. We have a mantra at MFS which says, never let a good crisis go to waste. And I think one of the problems that we as investors have is that when equity markets go down, we tend to shut down. If I said to you that the car dealership down the road is selling cars today and only today for 50% less than they were selling them yesterday, you wouldn't even let me finish that sentence. You'd all be kicking tires at the local dealership trying to figure out what kind of car you're going to buy. However, if I said to you that the stock market is down 50% from where it was yesterday, and I think it's a great buying opportunity, the first thing you say to me is, well, maybe it could go down a little more tomorrow. But we have to take advantage of these opportunities, and I think the market is really giving us an opportunity, because stock markets look really interesting to me right now, especially markets outside of the United States. Because the US has had a phenomenal run. And unfortunately, we as Americans tend to walk around with blinders on and really not look at what's going on outside of the United States. Now, the US makes up about 50% of the world's market capitalization. But the US is dominated by really large cap stocks. If I took the market cap of the 5 largest stocks in the United States, Apple, Google, Microsoft, Facebook, and Amazon, Think about that. 10 years ago, if I would have said those were the 5 largest companies in the United States, you would have said to me, no way. They would have been companies like ExxonMobil, companies like Walmart, companies that we would all recognize. And today, they're basically all technology companies. If I took the market capitalization, which is basically whatever shares they have outstanding, multiplied by that share price. So if I took that number and added it together for just those 5 companies, they'd be larger, or they would be the 4th largest stock market in the world. So, you know, what we have to look at is those opportunities outside of the United States. And that 50% market cap, as I said, is a little misleading because the US is dominated by large cap stocks. If we look at the world's investable opportunities, the US only makes up about 25% of the world's investable opportunities. That means 75% of the companies that we can invest in as investors are outside of the United States. And this is a part of the world that's growing very quickly. If we think about it, today emerging markets make up 1/3 of the world's GDP. In 2000, they made up 1/5 of the world's GDP. So they've gone from 1/5 of world GDP to 1/3 of world GDP. Now, if there's nothing else you remember from what I say today, it's that the world is changing. The world is changing at an unbelievable pace. And sometimes we ignore that. We don't realize it. We don't look at it. Do you realize that China and India combined are graduating close to 1 million scientists and engineers on an annual basis? Do you know how many we graduate in the United States? Less than 70,000. And that number is getting less and less every year because less and less kids want to study science and engineering. It's too difficult. We now graduate more kids with degrees in sports physiology than we do with degrees in engineering. Now, that's great if you want to come to the United States for a massage, but it does nothing with respect to our competitiveness. The rest of the world is trying to figure out what we have, and they want a slice of that pie. Now, 85% of the world's population lives in the emerging part of the world. 85%. And they're all trying to join the middle class. They're all trying to increase their disposable income because they're all trying to live this life that they see elsewhere. And one of the greatest vehicles for that income equality in the rest of the world is the internet. Because wherever you live in the world, you can go onto the internet and see how the rest of the world lives, which 10 years ago, 20 years ago was impossible. And once you see the way the rest of the world lives, you're no longer accepting of your situation. You're trying to figure out, how can I change this? What do I need to do to change the current environment that I live in? How do I join the middle class? How do I enjoy all the spoils that belong to those people that are in the middle class? Think about something as simple as travel. Yesterday I read a statistic on my way over here that the United States now, as a population, 45% of the population has a passport. I remember years ago when I read something that said that less than 10% of Americans have a passport, and I said that can't be true because just about everybody that I know travels. But then I said, I live in the East Coast part of the United States. If I eliminated both coasts, could I see less than 10% of the population having passports? And I said yes. As a matter of fact, being the geek that I am, I decided to actually see if I could determine what the percentage of passports were in the United States. And this is probably when I started at MFS in 2002, thereabouts. Now, the US will not give you statistics on how many passports they have as a percentage of the population, but what they will give you is how many passports are issued on an annual basis. So what I did was I looked at 10 years worth of data because I know that I have to renew my passport every 10 years. I tried to make adjustments for kids because I know that kids have to renew their passports every 5 years. And I actually came out from a percentage standpoint that about 7% of Americans have passports. Now, that all changed after 9/11, because prior to that, we could go to Canada, we could go to Mexico without passports. But after 9/11, you could no longer leave the United States without a passport. And so when I saw that 45% of Americans had a passport in this article that I was reading yesterday, I was actually quite surprised. And 2017 was the year that Americans traveled most outside of the United States. So I found that really interesting. Now, one of the companies, we've been investing in online travel agencies in China and India. And these companies are growing like weeds. And the reason we're doing that is because as these individuals in the emerging part of the world start attaining or reaching the middle class, one of the first things they want to do is travel. And so I looked into the percentage of people in China that have passports, for example. It's less than 10%. But 10% of the population having passports, it's the law of large numbers. 1.3 billion people, 10%, 130 million people. If 45% of Americans have passports, we're talking about almost the same number. So whenever I travel, throughout the world, I see a bunch of tourists from China or from the developing part of the world, and that excites me. Because all I think about, if less than 10% of the population has passports today, and all these people are thinking about is how do I get to the middle class, and how do I continue to purchase or find my way in an environment where I can do the things that I see other people around the world doing, that's a perfect scenario for the investments that we're making. And again, 85% of the world's population lives in emerging markets. Over half are less than 40 years old. So when you think about that, they haven't even reached, in many cases, maturity as consumers. And so, folks, we can no longer ignore what's going on in the rest of the world, because the rest of the world is trying to figure out how to catch up to what we're doing. The other thing is that the US stock market has had a phenomenal run over the last almost 10 years now. Starting in 2010, to where we are today, the US has had an unprecedented run relative to markets outside of the United States. So when you look at long-term data, and one of the data that we looked at and we spoke about yesterday was going back to 1971. And just looking at the relative performance of the US market as defined by the S&P 500 relative to non-US markets as defined by the EFA index, and trying to see, in how many periods that one outperformed the other. So going back 46 years, the one thing that we saw from that was that the US outperformed in 23 of those years, and international markets outperformed in 23 of those years. However, since 2010, the US has outperformed international markets by over 130%. So we've had an unprecedented run of good numbers coming out of the United States, and also from a performance standpoint, far outperforming what's happening in the rest of the world. Now, I think that the US still has a good year from a stock market standpoint in 2018. However, I feel that there's going to be more pressure on US markets than outside for two reasons. I think margins in the United States have been way above trend. So US companies have been over-earning since the global financial crisis. Think about it. You guys will understand what I'm going to say here. Since the global financial crisis, American companies were very adept at becoming lean and becoming very productive. So unfortunately, they shed quite a bit of labor, which is a lot easier to do in the US than it is elsewhere in the world. They cut costs tremendously. And so whatever revenue was coming in was magnified in the bottom line because they eliminated a lot of those costs. There was a lot of operating leverage there. So if you were making 5% in revenue, you were doing such a good job at cost control that your earnings were actually going up by 10, 15, whatever percent. That took a lot more time to happen in the rest of the world, so U.S. companies recovered a lot quicker. But I think the U.S. companies have been operating at unrealistically high margins. And if you take wages, if wages start to go up, that's going to put pressure on margins. If capital expenditures, buying equipment, goes up, that's going to put pressure on margins. And we've been underinvesting for a number of years because CEOs and CFOs have been afraid to buy new machinery or buy new equipment because they're not sure from an economic standpoint, or they still don't feel as good as they did going back before the financial crisis. So if we start to see that pressure, margins in the rest of the world have quite a bit of a ways to go up. And so these markets have always traded at a lag relative to the US. So I think it makes total sense to start looking at your international exposure or your lack thereof. Because the average US investor has a little less than 15% of their portfolio in non-US markets. I think that's, really low. Again, I said a little earlier that 50% of the world's market cap is in the United States. So theoretically, 50% of your allocation should be outside of the United States. I said theoretically, because if I ever said, I think you should have 50% of your assets outside of the United States, you'd basically turn off, not listen to anything else I said, because you said, this guy's been smelling too many fumes from those airlines he's on. But at the end of the day, 15% is way below where it should be. Folks, the world is changing. And what are we doing to take advantage of what's happening outside of the United States? How are we looking at the way this world is changing and these changing opportunities? Because I think that sometimes we ignore what's happening elsewhere at our own cost and our own peril. We at MFS think that earnings and, more importantly, returns on stock markets outside of the US over the next 10 years are going to be much better outside of the US than the US. And again, we still think the US does okay, but we think those opportunities are going to be much better elsewhere. So I'll stop there. I probably spoke for a little longer than I wanted to, but more importantly, I'm interested in your questions, because I think that having these types of formats are really beneficial to someone like myself, because sometimes we live in glass huts or bubbles, and we really don't get to hear what most of the people out there are thinking, or what most anyone is feeling about what's going on in markets. You can ask me anything, and if I don't know the answer to it, I'll make it up, so we'll be okay. We have pretty much an open forum here, so I'll take your questions if anyone has one. Yeah?
How is big data influencing the direction ebbs and flows of the market, and what countries out there do you see taking advantage or capitalizing on big data capture?
Yeah, I mean, at the end of the day, data is increasingly, look, this is the business of information, right? And if you have information, hopefully you make better decisions and get better performance from that. And so from a big data standpoint, the ability of companies today to take all this information and kind of compress it and get real-time information on moves that they should be making or opportunities that exist that they may not have thought of has increased rather dramatically. One of the things that we've done at MFS is we've taken that big data, or we've taken our quantitative group and have them working with the fundamental side, the guys who are actually picking the stocks together and put together blended products, so that they're taking advantage of this information, this data, combining it with the kind of the on-the-ground work that we're doing from an analytical standpoint, and trying to put together portfolios that take advantage of both. And again, I mean, that's a great example of how the world is changing in terms of big data, because the world is getting a lot smarter. And again, that information is much more distributable today than it was 10 years ago, 20 years ago. And so to the extent that that happens, we're going to see pockets of innovation in different parts of the world that historically we may not have seen. And so, I think it's exciting. I think, look, one of the things about technology today is that it no longer moves in an additive or a multiplicative form. It now moves exponentially. And we think about how quickly technology has changed our lives in the last few years and how much more quickly that pace will come as we go forward. So I think that's something that we all have to think about, and we are thinking about how we can use that to our benefit as we go forward.
Can you provide some perspective on financial transparency in international markets as you advocate for a theoretical 50%?
Yeah, so I get this question a lot, where people say to me, how much do you trust international markets? Because, there may be a lack of transparency. And what I say to them all the time is that the supposition of that question is that you trust U.S. financial markets and U.S. Standards. Because, look, we live in the most prosperous, most regulated place in the world, yet we had the global financial crisis in 2008 because there were a bunch of institutions doing things that they shouldn't have been doing and pulling the wool over people's eyes. Heck, you guys live in Houston. You know it better than I do. Enron. How is it possible that one of the largest capitalized companies in the world was basically smoke and mirrors? And so, do we have a lack of transparency in markets outside of the United States? Absolutely. Are the local authorities moving in directions that they should? Absolutely. And so, one of the things that we've seen in non-US equity markets is that more and more of these markets are moving towards international or global standards and not necessarily just local standards. Again, can we change things? Yeah, there are things in markets that happen outside of the United States. But that's why you hire individuals like MFS to look at your opportunities outside of the United States. Because we're not just looking at what companies are going to give us the biggest returns. We're also looking at their management. We take more decisions based on whether we trust management or not than whether we think it's going to provide some good returns. Because if companies don't have good ethics, if companies don't have good standards, eventually they're going to have to pay for that. If they're polluting more than they should, if they're not looking at social issues that are taking place, eventually they're going to have to spend quite a bit of money to right what they've done wrong for a number of years. And so one of the things that we look at is whether we believe that the management of these companies look at us as potential partners to help them grow the share capital of their firm, or do they see us as cheap, easy sources of capital in order to enrich themselves? And there are companies that we think are really great in the US and outside of the US where we have no faith in management. And so when we have no faith in management, we will stay away, even though there may be quite a bit of other people investing in some of these companies. There was a question in the back? Yeah.
I've been hearing a lot about cryptocurrencies.
I'm sorry, a lot about currencies? Cryptocurrencies.
And all that. Is that an Enron play, or is that an actual
I am going to tell you right off the bat that I am not an expert on cryptocurrencies. What I will say is that at the height of the cryptocurrency mania in December, these things were trading at 5 or 6 times what they're trading at today. And so everyone who got excited about cryptocurrencies in December is crying right now. And I live by a simple premise. If I don't understand something, I stay away from it. I live by a second premise, which is if there are too many people talking about something or looking in one direction, I want to run in the opposite direction. And so when my brother calls me up and he tells me, what do you think about Bitcoin and whether I should be investing in it? I says, you just seal the envelope, which tells me I want nothing to do with this stuff. So I think, look, you really have to understand this stuff, and that doesn't take a day or two. That takes quite a bit of time. You really have to know what's going on there. And if I were to bet on any of these cryptocurrencies, it would be with money that if I lost it, fine. If it made money, fine. I think too many people talk about the fact that the Winklevoss twins, those are the guys who sued Facebook because they were at Harvard, and they asked, what's the head of Facebook? I forget his name. Mark Zuckerberg. They asked him to start this program to rate people on campus. And Facebook actually ended up paying them out, settling with them $60 million. And they invested $11 million of that in Bitcoin. And at the height of Bitcoin's mania, they were paper billionaires. And I think people look at something like that and say, wow, I mean, I could be that person. But they took an unbelievably big bet, and it paid off. But the chances of you taking an unbelievably big bet today on something like that, not so good. I'd be very careful. I'm out of time?
Yep.
All right. Thank you very much.
Fantastic. Okay, our next speaker is Jenny Phillip. She is from the Greater Houston Partnership. Jenny Phillip is the regional economist and director of research at the Greater Houston Partnership. She studies Houston's economic trends in areas such as employment, energy, real estate, and international trade. Jenny also contributes to the monthly publication of GHP's Economy at a Glance, and the annual publications of the Houston Employment Forecast, Houston Economic Highlights, and Houston Facts. Prior to joining the partnership, Jenny worked for the Millennium Challenge Corporation in Washington, D.C., analyzing the eligibility indicators used to disperse over $7 billion to 25 developing countries. She also worked at the U.S. Department of Labor on identifying labor rights issues surrounding the Colombia Free Trade Agreement and the African Growth Opportunities Act. You're very busy. Jenny received her master in public policy from Georgetown University and her undergraduate degree in international business from the University of Texas at Austin. She serves on the board of the Collaborative for Children organization and is an alumna of the Center for Houston's Leadership Forum. Jenny and her husband have been foster parents to rescue dogs through Scouts Honor. She is a native Houstonian and has lived in the city off and on for over 20 years. Let's welcome Jenny.
Good afternoon. We're going to run through this quick, okay? Because I want to be very respectful of your time for leaving at 1. Is that the correct time to leave? Okay. So for those of you who were at the Economic Outlook event in December, the Houston metro area is expected to add 45,500 jobs. So I've been looking at this graph over here. So who's in charge of designing this one? Okay, so you should update this with the tape up. But intro for my presentation. So I would recommend a tick up, but slightly. So 45,500, and it's from December 16 to December 17. It's actually really important to note those dates, and a lot of that is due to the Hurricane Harvey effect, right? Where a lot of the work and the recovery is still continuing into the first half of the year. It'll wear off into the end of the year, and so there's sort of an artificial uptick in activity in the end of 16, early 17, that is going to wear off by the end of 18. Sorry, not 16, end of 17. So where will growth occur? Instead of trying to remember every one of these industries, just think every industry but information and construction will grow. So construction information, we're looking at declines there. Once again, the importance of understanding the time frame. So for construction, we are seeing an uptick in activity right now, but that is a lot of Harvey-related recovery work. We do not see a pipeline growing in terms of office construction. That building cycle is wound down. The pipeline, I believe, is 2 million square feet of activity. At the height, we were at around 14 to 20 million square feet, depending on which commercial real estate group you're looking at. Multifamily building is also slowing. There's some discussion of proposed new units, new buildings being made, but until those investors actually break ground, we're not counting those. The industrial activity on the east side of town, the $50 to $60 billion in petrochemical plant expansions. That's also wound down. There's about a second wave of expansions in those petrochemical plants that may come about, but it will not match that $50 to $60 billion level of investment. So we will see a slowdown in construction employment. And to preface this is for the 9-county metro area, the Houston metro area. And it includes this area, so Harris County and the surrounding counties. Now, information, that is the group that includes your paper publishing companies. So how many of you guys used to read Houston Press on paper, right? So they shuttered in terms of their print publications, but they're active online. So the change in employment has declined even though they're still continuing operations. So that's where we'll also see some decline. And it's not specific to Houston. This is a change in the industry that has been happening for over a decade and will continue to move as we move to more digital technology in the future. And we do see flat, neutral movement in energy. And in energy, we're talking about both upstream, midstream, downstream. And we'll get into details into this in a little bit. And the previous presentation was a great primer because Houston is a global city. The growth in Houston completely depends on the growth of the US economy and the world economy, especially when energy is flat, right? So from 2010 to 2014, while a lot of the US economy, the world economy was trying to get out of the financial recession, Houston benefited from hydraulic fracturing coupled with directional drilling. Right, so we saw these immense growth in shale plays, and so that's what brought us out of that recession. When energy prices fell, we needed to completely depend on growth outside of Houston, so in the US and the globe. So it's great news when you hear strong GDP estimates and forecasts for the world and for the US. We will see improvement in the energy industry recovery, but we'll go into details as to why we still remain pretty neutral in terms of the employment outlook for energy. So there's a difference between whether or not we see improved oil prices, improved rig counts, and how that translates to actual employment and head count. And of course, a big part of what drives our economy too is population growth. And there's a lot of population-based industries that you saw on the slide with all of the growth in the industries, so education, healthcare, those are all population-based. And what drives population here? We'll get into that part at the very end of the presentation. So how many of you guys have thought about upgrading to a new phone recently? Okay, and have you just kind of puzzled and looked like, so how exactly is 2018 different, or is the iPhone 8 different from the iPhone 7, right? Like I can't really tell the difference. You just know it's a little better, right? So you should be upgrading. In the same way of thinking about the Houston economy, 2018 is just a slightly better version of 2017. Right, so that's why I'm at here. You can have it tick up, but it's slightly neutral. So we'll get into what's driving sort of a better outcome, but not something fantastic and different. A big part of what will influence 2018 is what happened last year. Breaking out all of the sector growth and employment, once again from December 16 to December 17, what we're seeing is top line growth of 46,000. And I'm sure you guys are like, wait, aren't you supposed to be a math person, right? So your forecast is 45,500, and 2018 is supposed to be slightly better than 2017. Here you're saying we grew 46,000 last year. So order of a magnitude, it's probably not correct, right? What's important to note is that the Bureau of Labor Statistics issues this monthly employment report that is a survey of 30% of the payroll employment in Houston. Then in March, they go back and they call it the benchmark revisions. They revise all of that data, actually going back to 2 years, and restate those numbers. We're not sure what those expectations will be. March 9th is when the data will be out. We'll be doing a lengthy write-up on that as well. But the idea is we will be below the long-term average, but not far below, right? Long-term average of Houston growth is about 55 to 65,000 in employment. What we're seeing is going to be anywhere from 45 to 50. The important thing about forecasts is not to put all of your focus on that point estimate and say, oh, you were off by 200 or 300 jobs. It's understanding the underlying trends that drive that forecast and how you take that information and apply it to your business decisions. So when we look at how Houston grew over these 12-month periods, going as far back as 2007, you can see how hard we were hit during the recession, right? This was across the U.S., nothing specific about the impact. In fact, if anything, we had less of a job loss than most metro economies. Then we came back strong, right? We had phenomenal growth. And my job was easy. I got to go out and I say, hey, guess what? We added 100,000 jobs. Done. I'm good. We'll see you later. See you next year. But we wanted to caution members and we wanted to caution the community that 100,000 is not normal either, right? We knew that this would not last forever. When I would go and speak to commercial real estate groups, people who lived through the 80s in Houston, and they would see $106 oil, they would tell their young brokers, make your money now, save it away, don't go buy that fancy house and car yet, because this will not last forever. Ride it as long as you can, but just know and understand the volatility of the energy industry. And then lo and behold, what happens, right? When I speak about these benchmark revisions, it's important to note also that in 2015, the initial release was that we had added about close to 36,000 jobs. Then they came back and revised it that same time, that March frame, down to about 15,200. Then 2 years later, they revised it to 200. So that's why these revisions matter. But we're very much focused on the future, right? So nobody's going to be paying attention other than data nerds, right? That, oh, they went back and they revised those 2 years. So it's our duty actually to come out here and tell you, it really does matter what happens in these revisions. Not only 3 months out, a year out, but also 2 years out for understanding what actually happened in your local economy, in your national economy. It's easy to get caught up kind of in the most recent numbers that come out and make decisions on that. But the restated numbers give a really good picture of what happened. So you can say that the energy industry went through the worst downturn in history of their industry. But separate from that, although Houston is the energy capital of the world, we were able to get through that worst period of time for the industry relatively unscathed. We'll go into details on upstream in a little bit. What that means is if you take a look at 12-month change, right? So this is not overall employment in energy, in upstream energy. This is the 12-month change. So how many jobs did you add? How many jobs did you lose over a 12-month period? So you can see how we kind of hit the last nice bump in a 12-month growth was about 5,400 jobs added September 2014. So oil prices started to fall in June 2014. Went from $108 down to February 2016, $26. And then now you can see how in employment it started bouncing back, but very slowly. We just recently reached that zero line, right? So no growth is the new growth in upstream energy, unfortunately. And what I mean by upstream energy is your exploration production companies, so your Chevrons, Exxon, BPs, and your oil field service companies. And it's interesting to see how most recently the recovery in this has been primarily focused on the oil field service companies. What you see is a dotted line, which was the number we saw earlier, the top line numbers. The two components broken out, so exploration production companies being oil and gas extraction, the light blue. The gray line is your oil field service companies. So the Halliburton, the Schlumbergers. How many people know someone who works at an oil field service company, or you have a client that is an oil field service company? Right. So when oil prices started falling, what happened? The E&P companies go to the OFS company and say, cut your prices. Right? They're like, okay, we don't want to lose this contract to another competitor, we'll cut the prices. That's why that break-even price for WTI keeps moving from 85 to 75 to 65, because maybe Halliburton doesn't need a fancy Christmas party, right? So then, I'm sorry if anybody here works for Halliburton. So what then we see is the volatility in oil field service is a lot more tied to overall energy prices, overall rig counts, right? Because they have to be on the taking end of this. The E&P companies can absorb some of this a little bit more, but that also means they don't shed as quickly, but they also don't hire as quickly. So right now, the oil field service companies, they're the ones where you actually see a lot of the movement in employment, especially. And one way you can see this, for those of you, how many of you guys have read the Dallas Fed's Energy Industry Survey? How many of you guys have the energy industry as a very important component of the work that you do? Okay, then you need to read the Dallas Fed Energy Industry Survey. They survey close to 200 energy executives operating in their region, so primarily in Texas, some Oklahoma, or some New Mexico, Oklahoma, Louisiana. And what they ask them is several sentiment questions. The one that's being reflected here is they asked in Q4 2017, so compared to where you are now in Q4 17 to where you were a year ago in Q4 16, have you increased, decreased, or maintained your employment? Now, the responses where you see in E&P employment is relatively no change. That's the primary, about 60% said that, right? Then you see in OFS employment, a lot more movement in hiring. Almost, about 55% say that they actually increased headcount. And once again, that corroborates with what we see in the employment data. Now, manufacturing. In Houston, manufacturing, quite a bit of it is tied to energy. So that's why this also feeds into what's happening in upstream energy. The dotted line is overall manufacturing. You can split manufacturing into two groups, your durables and your non-durables. So your durable goods, those are going to be like the equipment and the product that goes into drilling rigs, right? So the blue line is your durable goods. Once again, following the trend that you saw in the OFS companies and what you saw in terms of overall mining and logging hiring. Then the non-durable goods, that's your refining and your chemical manufacturing. And you can kind of see where as a share, it's relatively stable. So then you're wondering, okay, well, the $50 to $60 billion in chemical plant expansions, how did that not increase headcount as much as the movement here? So you do see some movement over here, right, as some plants were brought online. But something you have to keep in mind, take for example the ExxonMobil Baytown plant, close to $1 billion in capital investment, about 10,000 construction workers, but only 350 permanent workers, right? So you need a lot of people. It's a capital intensive project, but once that winds down, right, so once that 50 to 60 billion is spent, then the people that are needed to actually maintain and run those plants, it's not a lot. There is a multiplier effect because there's turnaround crews that come in, there's maintenance, there's a lot of good contract work that can come through. But in terms of how that would reflect in overall employment in non-durable manufacturing, it's a tiny movement, a tiny tick. Offsetting this in non-durables, we actually saw some losses in food manufacturing. So that kind of threw off a lot of the gains that we would have seen specifically tied to the petrochem expansions. Now, Mr. Melendez had spoken about the PMI on a world scale. There is a Houston Purchasing Managers Index. And this is such a gift for the region because not every city gets a PMI. The way that we would read this is any number above 50 shows oncoming expansion in the economy 3 to 4 months down the line. Any number below 50 shows contraction. So as you can see, coming out of the oil and gas boom, we were under 50 as oil prices were depressed. Then we came out for about 10 to 11 months above 50, right? We were seeing expansion, seeing growth, and then Hurricane Harvey hit. PMI fell below 50 for 3 months, and now we're back up to about 54.8, and that's the highest we've been since October 2014. So PMI is looking good, which is a good news for anybody who's in manufacturing, particularly in energy. Now, what we are seeing is record high prices, record high being 60, right? Some joke that 60 is the new 100, we don't know yet. But in terms of a forecast, the estimates for most groups, the Energy Information Administration, they're saying $58 on average for 2018. So what we've seen in the first few months of this year, first couple months of this year, is probably the highest that we'll see through 2018. So enjoy the 60, mid-range 60 while you can, but the expectation is that it won't bounce that much higher. Now, what does this mean in terms of activity in the oil field, activity in employment? When the Dallas Fed Energy Survey was also asking another question, what price would you substantially increase your capital investments? about 42% and 31% together, they're around that $60 window. So that's why that threshold of $60 is so important. But once again, that joke about how you negotiate prices with your oil field service companies, there's some wiggle room in that number too. But as of now, $60 is that band. But the rig count hasn't responded in the same way. Most of you guys know that the efficiencies that have been gained have been able to reduce the amount of rigs, even reduce the number of wells that would be needed. What that means is there are fewer people needed to manufacture the goods that go into this, right, because of the efficiency gains. The chief economist at ConocoPhillips is saying that we are probably 900 to 1,000 is probably where we'll stay for some time unless you see tremendous increases in oil prices. We will not get close to that 1,900 rig count ever again. So never even think that we will get back to that level, because that is how much things have changed in the oil field. Now, the other part of it too is you can say that production is growing, right? You read the news that Saudi Arabia, we will be overcoming or overtaking Saudi Arabia in terms of crude production this year, right? So fantastic news for US producers, North American producers, but it doesn't necessarily generate additional hiring. Now, once again, if you take a look at the Fed Energy Survey and ask them, you know, where is the increase in activity happening? It's not happening in employment, but it is happening in oil production and capital expenditures. Closer look, I think I'm running a little, so I'm going to kind of wrap up this pretty quickly. But in terms of construction employment, the biggest takeaway here is that we will have to deal with the effects of Harvey for some time. The City of Houston building permits we use as a proxy for activity throughout the region. What we do see is an uptick in that residential movement, which is that light blue line, and that's primarily in what they call the renovations, additions, restorations, and so those are the Harvey-related repair work. When you look at healthcare, thank goodness for healthcare in terms of its ability to maintain employment growth for the region and offset the losses in the areas of energy. So what you want to note about this graph is that all of the energy graphs, that zero line was what they were dancing around, right? So even though you see a slowdown, at least it's a slowdown in growth, right? It's always been adding jobs. Now, what's important to note is where is this growth coming from? How many of you guys remember Blockbusters, right? So what replaced all the Blockbusters? Mattress firms and ambulatory care centers, right? So this is where a lot of the growth occurred. That dotted line, overall healthcare, right? Ambulatory care centers, I mean, it's helpful. You don't have to drive all the way to Texas Medical Center, right? If you need urgent care, you can go down the street and take your pick of 4 or 5 different urgent care centers. But that light blue line is what helped move, that ambulatory care center movement, is what helped the growth in healthcare. Hospitals had some movement, but really it's those urgent care centers, outpatient centers. But that is starting to slow, right? You can feel that saturation in the market when you do see so many of them on every corner. What's also important to note is that, once again, this is not a Houston-specific trend. If you overlay the national 12-month growth rate in employment versus the Houston employment change, they are also, the U.S. as a whole is also slowing its employment growth. And so that is an indication of underlying issues in terms of insurance, in terms of patient delivery systems that needs to be basically going through an evolution, right? It has to mean something when you have Berkshire Hathaway, Amazon, and is it JP Morgan or Citi that's going through and saying, you know what, let me handle this. We're just going to deliver healthcare we are going to figure out how to fix this for our employees. And so this is kind of a signal of oncoming change in terms of what's happening in healthcare. Now, to wrap up, population growth throughout the metro area. This is so important to look out because this is your workforce, right? For Houston, we are the 5th largest metro, 4th largest city. Harris County is the 3rd largest county in the U.S. We have about 6.8 million people. We were the fastest growing metro. If you look from 2010 to 2016, the most recent data available, we were the fastest growing metro, and we also added the most people to our region than any of the other major metro areas. Right? So I'm sure you guys can feel that in terms of congestion and home prices. But what makes Houston unique is how we attain that population growth. There are three main components in population growth, and Houston's fairly evenly divided if you look at net natural increase, so more people being born than dying, and migration, more people moving in than out, and migration can be split between domestic and international. Now, if you look at how the metro areas break out those components, and it might be hard to see here, but if you look at New York, Los Angeles, Philadelphia, Chicago, they actually had net loss if you didn't take into account the natural increase that's happening, right? That the people who are already living there are going to stay there and have kids, et cetera. Typically, net migration is how we understand employment opportunity. People don't want to move to